Where do you peg the probability of a recession?
I'd say about 50-50. It's pretty close.
How it's going to play out, how long it's going to be, and how deep it's going to be.
Recessions also often impact the valuation of other asset classes.
I do believe recessions are really inevitable.
I do have some good news for you guys, but in this video, I'm going to share with you how to invest in startups during a recession or an economic downturn. Now, this video is super important, so make sure you watch it closely because I'm going to share 5 red flags that you have to watch out for before making an investment in a startup. And I'm also going to share 5 things to look for that these startups absolutely have to have before making that investment. Now, before we get into it, I want to clear up a few different misconceptions, and I did some research and I found some really compelling data. So here are 4 different points that I want to make sure I get across to you guys. Number 1, the number of angel deals during an economic downturn actually increases over time. A lot of people think that people are tightening up their wallets and they're not investing, and that's simply not the case. The data shows that the number of angel deals and angel investments actually has increased over time during economic downturns. The other misconception is that check sizes stay the same. And the reality is that even though the number of deals are increasing, the check size per investment is actually decreasing. When we can see the consumer behavior is a little bit different. So people are not investing as much, but they might be investing more frequently. Thirdly, capital raised by VCs is decreasing. So people are choosing to either hold on to their cash or invest in individual startups, and they're not investing in funds. So institutional money, VC money, is actually drying up during an economic downturn. And as a result, VCs have less funds, and therefore for startups in later stage, whether it's Series A, B, C, whatever, there is less opportunity for them to raise because the funds have tightened their belt. So now that we got a few facts out of the way looking at the data, let me share some good news on what an economic downturn can mean and what a recession can mean for the startup investing ecosystem. So startups that were launched during the 2007 to 2011 Great Financial Crisis, the Great Recession, whatever you want to call it, these are just 4 examples of multi-billion, $10+ billion companies that were started at that time. So this was about close to 15 years ago. We have Airbnb, which has a market capitalization of over $70 billion, even with the recent drawdown at the time of this video. So even if the company's worth maybe $60 billion right now, doesn't matter. This company was launched at the seed of the Great Recession, peak fear, and no one thought starting a business was a good idea. You have Pinterest, Uber, Square, all worth over $10 billion. All these companies were started during the Great Recession. So it is true that a company can flourish and raise investment during these times, and a bad economy simply weeds out the bull crap. It takes out all of the BS, and a lot of companies that don't really have anything there, they're not going to survive. They're going to die. It's survival of the fittest. Thirdly, startups can pick up significant market share. So only the strong will survive. So if you have a witty CEO and you have a strong team and you have a product market fit, you will steal market share away from the competition. And these are things that you need to look out for that I'm going to talk about to make sure that you're making the right investment and picking the winner, because if you pick the loser, you're just going to lose all your money, because market share will be stolen by the most successful startups and the most savvy entrepreneurs. And the amount of angel investing deals stays the same or actually increases. We already talked about that from that misconception. I wanted to clear that up. Now, I want to talk about this Y Combinator email. It has become infamous in the startup scene. And Y Combinator, if you're not familiar, is like the greatest startup accelerator, early stage investor of all time. A few of these companies, Airbnb most notably, actually went through the program, and they basically sent out an email to all their founders warning them and giving advice. This applies to both entrepreneurs and investors. If you're thinking about investing in a company, you got to pay attention to this stuff. So let's go over these 10 quick bullet points, then we'll get into the bonus tips that you guys want to pay attention to. So tip number 1, or point number 1 of the email, is no one can predict how bad the economy will get. So if you're in a recession or an economic downturn, you really don't know. And that's why some of the stuff we're going to talk about and the remaining points here are so important, because you can't take for granted the situation that you're in, because it could get a lot worse. Number 2, plan for the worst. So obviously the thought here is it's going to get really bad. It's going to get ugly. So you want to cut costs and extend runway to be default alive. We'll talk about default alive versus default dead. Number 3, consider taking funds from existing investors to extend runway. Runway just means how much time the company has before they run out of money. So if you can raise more money, raise more money. Number 4, it's your responsibility to survive for at least 24 months. We'll come back to that 24 months. I have that here on the board. That's important. Number 5, poor public market performance of tech companies directly impacts VC investing. So we already talked about that. We talked about how the money starts to dry up in VC funds, and for later stage startups, especially post the friends and family, post the angel investing, that really can throw a wrench in things because they can no longer raise funding, and they might go out of business just because of that, even if they had the angel investment that you may have invested in. So it's really important to consider that. They can't raise funds from their LPs as easily, and the same thing applies for angels who are investing in those funds. Number 6, if the company was started in the last 5 years, prior fundraising success is not indicative of future fundraising success. What that means is that the last few years, in the late 20 teens, basically 2014 and beyond, it was so easy to raise money relative to after 2021. So companies may have had it easy, and just because they raise money doesn't mean they can raise money in the future. Number 7, if the startup is pre-product market fit, don't expect to raise until product market fit. This basically means if you don't have product market fit, you're screwed. And you need to be able to get to product market fit as nimbly and as efficiently as possible. Number 8, if the startup is raising in the next 6 to 12 months, that's the peak of the downturn. Chances of success are low despite company success. So even if your company's killing it, it's gonna be really difficult to raise money. You should pay attention to that if you're an entrepreneur or an investor, because this is indicative of the future. If you can't raise money now, when will you raise money? Will you be able to survive to that point of when you can raise money? Number 9, you can pick up significant market share because most startups will fail to plan ahead and they don't realize that they're screwed until it's too late. So that's tip number 9. And tip number 10 is to watch how to save your startup during an economic downturn. This was by Delton Caldwell and Michael Seibel. These guys are legends in the startup investing community. So check out that video. It's like 30 minutes and they talk about default alive or default dead. And it's an essay that Paul Graham, the founder of Y Combinator, actually put together. So let's go ahead and look at these red flags that happen during a recession that a lot of startups are guilty of, and you do not want to invest in these startups. Remember, I'm not your financial advisor. This video is for entertainment purposes only. Do your own due diligence, but this is just my perspective on this. Number 1 is arrogant CEOs or founders who are simply not acknowledging the fact that there is an economic downturn happening, and they're almost overly optimistic. It's like they're basically mental and they don't believe that this can impact them. Regardless of what industry you're in, there is complete failure in the economic system during a recession. No one is insulated. Everyone feels the blow, some obviously more than others. So the CEO has to acknowledge this and create a plan for how to deal with it. But without the acknowledgement, that's a huge red flag. Number 2, having a high burn rate. Now the burn rate is how much money the company is losing every single month. Now, if a company is losing $100,000 a month, that may sound like a lot, but if the burn rate used to be $500,000 per month, they've been able to reduce it to $100,000 a month, and they have $25 million in the bank. That's a pretty good environment relative to a company that's burning $100,000 a month and they only have $500,000 in the bank. You see, the runway is 5 months versus many years into the future. So it's really important to understand, what does a high burn rate mean? And if you see a high burn rate that doesn't last 24 months, then the company's in a really dire situation. Number 3 is careless spending. So if you see, like, the company just bought an office building, or they just signed a 5-year lease for a co-working space or something like that, if they're doing financial decisions that don't really make sense, given the fact that we're in an economic downturn or recession, that's a huge red flag. Number 4, excessive hiring plans, not having a model. So if we look at the investor deck, if it seems like, wow, they're gonna really go after this, they're gonna spend all this money here, they're gonna buy an office building, they're gonna hire all these people, they're gonna build out a sales team. Well, what's plan B if you don't have the funds to do that? If the revenue isn't there, if the fundraising isn't there, where is the plan B and plan C? And you should see something like that reflected, especially in a time of fundraising during a recession. And if the company doesn't have that, it's a huge red flag. They don't know what the heck they're doing if they can't hit those targets. Number 5 is not raising enough money. Now, this is a huge one. Back to the example of $100,000 a month burn. If there's only $500,000 in the bank and the company raises $200,000, It's not enough. We're looking for 24 months. I mentioned that a few times now. And if the company can't get to this 24 month, then it's basically too little, too late. You have to raise enough, and if you try and raise money and the company is raising funds, they need to make sure they're almost over raising. It might come at the dilution of the company, but that's what's potentially required depending on the market and the feasibility of scaling the business. Those are 5 different things to look out for. Those are all red flags. There's a ton more, but these are 5 of the most significant that you've got to watch out for. But if you guys are interested in how to invest in startups, I actually published a book titled How to Invest in Startups. It's on Amazon, and you can check it out, link down below, and I go over all of these different elements, including some of the things that we're going to talk about here. These are 5 things to look for when you're going to invest in a startup. Now, you should already have done this due diligence before you make the investment, and I talk about this extensively in my book, so make sure you check that out. But here's the first one. Is the startup a painkiller or a vitamin? This is a question that you need to ask yourself. In other words, how important is it for this startup to exist in the world? What is the problem that they're solving? Can literally this problem be solved by a competitor that's a 10th the cost? Or are they solving something that is absolutely painful to a specific market? And that's a painkiller. If it's not, then it's considered a vitamin. What gets trimmed first in a company's budget or a consumer's budget? It's vitamins. A painkiller is not going to get trimmed in the budget, so there's a clear differentiation that you want to do the research and diligence in the market to understand, is this startup solving a problem that is so painful that consumers or businesses are willing and able to spend money and continue to spend money even through an economic downturn? And if they are not, then it's a vitamin, and that company has a high risk of failure because that's what's going to get cut back when things get tight. Now, the second thing is answering the question, is the startup default alive or default dead? Now, what this means is if the company's revenue were to all of a sudden dry up, is the company alive or is it dead? Do they have cash in the bank? What is the minimum required to keep the company alive? And that's what's referring to default alive versus default dead. And if funds dry up and everything just kind of stops, is the company going to continue to operate, or is it dependent on something happening? And that's when you'd be default dead. So there's a few different ways to look at that, and that's why you should check out that video, because it could be interpreted a little bit differently depending on the market. So make sure you check that out. The third thing to look out for is cash. Cash is king, especially during an economic downturn, and you want to look for cash for 24 plus months. And the way you know that is you need to look at the company's burn rate. So if they're burning $100,000 per month and they only have $500,000 in the bank, that is only 5 months. If the company's burning $100,000 a month, averaged out over the last 3 months or forward looking the next 3 months, they need to have $2.4 million in the bank, or it becomes a risk. Ideally, they have $10 million in the bank if they're burning $100,000 a month, and they have easy access to additional capital, which is point number 4. Do they have additional access to capital? Do they have some kind of an institutional investor? Do they have someone with really deep pockets? Maybe it's you. Probably not if you're watching this video, but do they have some kind of a fund or a mothership that can just continue to funnel money into this? And is that mothership in a position where it's not going to be affected by a recession and they can continue to fund the business even through these economic slowdowns or recessions? And then number 5, is the CEO resilient? Have they proven it? Do they have the experience in pivoting and the flexibility? Again, this is one of the most important traits to look out for when investing. I actually have an entire chapter in my book, How to Invest in Startups, to identify the traits that you should look for before investing in any startup, because at the end of the day, the CEO, the founding team, they are the ones that make it happen. So make sure you check out my book. I also created an entire course on how to invest in startups. It is the Startup Investor Academy. Now, this program, I put a lot of work into it. I took all my knowledge of interviewing hundreds of CEOs, entrepreneurs, for not only my personal entrepreneurial journey, but writing the book and also investing in dozens and dozens of different startups online. So if you want to check that out, make sure you do. It's going to be the pinned comment down below, the Startup Investor Academy. Let me know what questions you guys have down below in the comments. I wish you the best. Good luck out there and take care. Bye.